few weeks ago, hardly anyone was talking about the Strait of Hormuz. Now it's everywhere. And with it, attention has shifted to the asset class most exposed, one that doesn't just affect investors, but shapes the lives of everyone, everywhere. And that's commodities. So, what's happening across the major commodity sectors? And of course, the $1 trillion question, what will happen next? Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mubin Tahir, Director, Macroeconomics and Thematic Research at Wisdom Tree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomics at Wisdom Tree.
Nitesh, eventful few weeks in the world of commodities. We know that you've been kept very busy by all the questions that you're receiving from investors. So a lot to cover. Let's aim to go through the four major sectors, starting with oil. I want to set the scene here, Nitesh. I know 7 years ago when I joined Wisdom Tree, I heard you when you were doing your commodity research bring up the Strait of Hormuz as something that is a risk. If in any geopolitical scenario that strait becomes closed, that's a choke point and that could create a risk. Were you surprised? Were you surprised? I imagine you weren't because you've been talking about this. I know many people around the world were perhaps not expecting the ripple effects here, but given you were already recognizing the Strait of Hormuz as such a big risk point, I imagine you were not that surprised when this whole conflict escalated into such a big issue for oil markets. What's your take?
Yeah, so the Strait of Hormuz, definitely the world's most important choke point in terms of transit of oil, natural gas through liquefied natural gas cargoes, and a whole host of other commodities. There's lots of metals that are shipped through there, sulfur, which is a key input for production of other commodities. Um, so Yes, it's very important. In the past, blocking off the Strait of Hormuz was almost seen as the nuclear option, right?
Mm.
It's so devastating that it's almost the last option being used, right? But clearly, what's happened this year has provoked Iran and that fairly surprise action that U.S. and Israel have taken has created a situation where Iran has um, reacted strongly. It's closed off the Strait of Hormuz, but it's also throwing missiles and attacking all of its neighbors as well. It's in deep protest, right? And so um, as part of that, we are suffering from the world's most well, the historically the worst impact on oil markets. Right, this really supersedes what we saw in the 1970s with the oil embargoes at that point. At the moment, just before the war, roughly 20 million barrels of oil moved through the Strait of Hormuz. That's roughly 20% of the world oil and 25% of seaborne oil. Most of that is shuttered. There's very little that moves via ships through the Strait of Hormuz. Yes, there are ways of offsetting that through utilizing pipelines elsewhere, taking longer shipping routes. Um, but once you sum up all the offsets, you still have a good 10 million barrel per day reduction in oil available to the world. Now that is really deep, and that's why we saw oil prices jump from around $65 prior to the war to 120 within a matter of days, and then we did see things cool off a little bit. That's because we saw some flows coming out from um, inventory as the International Energy Agency coordinated. a release of inventory of around 400 million barrels in aggregate from the agency and its members. And I think the market has generally been expecting um, a relatively contained, um, short-lived conflict, but it hasn't really been that. We're the third month into the conflict now, and we've gone from escalation to de-escalation, and back again every few days. Technically, we are in a ceasefire at the moment, but it doesn't feel much like a ceasefire. And there is that worry of the next leg of escalation. Even yesterday, when um, it's expected that Trump would be presented a set of new options for maybe a short, um, powerful new campaign in Iran, possibly including ground troops. Oil prices escalated. We hit a new high for this conflict at over $126 per barrel on Brent. But that shortly fell off. And the reason behind that decline was really to do with worries that a prolonged war will start to dis- destroy demand, that there'll be weakness in demand going forward. And the reason why that fear surfaced really yesterday is we started getting GDP prints for first quarter. So in the first quarter, the only 1 month of that quarter really overlap with the conflict, but it's already visible that we're getting some damage to the economy, possibly more visible in Europe than it is in US. But even US GDP numbers missed consensus targets, and by a narrow margin. But in the US, more so in Europe. But it is clear that these conflicts disrupt supply chains, stop people consuming the things they want to consume, prices go up, that hurts the consumer, and therefore reduces economic output. So um, that's really the state of things right now. We don't really know when the conflict would end. We know that Iran is here, on one end of the spectrum. US is on the other end of the spectrum in terms of its negotiations. Um, Getting to a middle ground looks difficult. It may be forced. We may get there because clearly everybody needs a solution at this point. But I think ideologically, the two sides are at very different points at this stage.
And of course, Nitesh, you mentioned the escalation, de-escalation, re-escalation cycle. It seems like that's happening on an hourly basis, if not a minute by minute basis. These prices move. So, worth mentioning to our audience, we are recording this on the 1st of May, and so of course, by the time you hear this, prices inevitably will have moved again. But Nitesh, it seems like when we were in late April, the ceasefire, in whatever form it is, was announced, and there were talks happening, and there were expectations of a peace deal. Oil prices fell into the early 90s, then they went up again as maybe the peace talks broke down, and now we're in the like you mentioned, the early 105, 110 range. What do you think are oil prices pricing in? If we take oil prices at 100 to 110, what scenario does that tell us our markets actually pricing in if oil is at 105 to 110? And what is the range of outcomes? Can it go much further up, and can it go all the way back down to pre-war levels at all?
Yeah, it's great to build out some of those scenarios. So I think the markets at the moment are pricing in an end of the conflict sometime this month, right? We've entered May now, and it does indicate that that's where they're sort of got anchor point. It's not just the markets. I mean, if you look at the latest IMF forecasts, or the World Bank has also published its forecasts and commodity views. They're all sort of got these scenarios built around kind of a May frame time frame. for as a baseline for the end of the end of the conflict. Um, now, you know, as I mentioned earlier on, the U.S. and Iran are somewhat polarized in terms of their negotiating position. We've been in this impasse for a while. It's hard to know exactly what will break that stalemate, but um, if it does get prolonged beyond May, I could easily see oil prices rise to $150 per barrel. Um, and if it goes on for longer than that, it could go much more higher than 150. Um, I think there's going to be a lot of visible pain to the economy the longer this um, conflict goes on. But yeah, if it goes beyond May, I would be looking around the $150 dollar mark. If we get a much quicker resolution, um, yes, oil prices could come down. We may go back to the 90s, possibly the 80s. Doubtful we'll go back to 60, 65, where we were pre-conflict, because um, the underlying geopolitical risks likely linger. A resolution made so, or you know, an agreement made so quickly is likely to involve a lot of compromises that both sides are probably going to be looking back with some sort of degree of regret, and therefore the risk of a new escalation or something else happening will always be priced into oil prices. So getting to 60, 65 will be very difficult. Um, but when we get that, if we do get an end to the war, there is Saudi Arabia waiting in the sides, looking for an opportunity for increasing its production and its export levels. It has a lot of spare capacity, which it can utilize. Um, and we've already seen some of the fallouts of this conflict with the United Arab Emirates leaving the OPEC group. So after 59 years and a bit, almost 60 years of being part of this cartel that is responsible for balancing the oil markets and managing supply there, it's had a fallout. It's seems unhappy with its neighbors in terms of the level of um, military protection against um, the drones and missiles that Iran had been firing out, and it's for years has had um, was disgruntled with the group, possibly Saudi Arabia in particular, that it wants to be able to produce more and utilize the infrastructure that it has been investing in for so long. So when the conflict ends, UAE will be very free to produce as much as it wants, so long as the Strait of Hormuz is open and it can get the cargoes out there. So we could see a lot of new oil come back into the market once the conflict's over and the Strait of Hormuz is open, and that is the critical thing. The Strait of Hormuz has to be fully open. Maybe that just another important point is that Saudi Arabia during this, sorry, Iran during this conflict um, had been charging some ships to pass through the Strait of Hormuz, um, and that could be potentially part of the solution at the end, that Saudi Arabia is given the rights to continue to charge ships, and possibly there could be a solution where US has revenue sharing rights in that as well. I think that possibly could be a way in which both parties could walk away and say, "Look, we've had." Um, we've come to a compromise, and there is some upside. We've both won in some way. That could be potentially end of the war. Yes, ships would have to pay more to move through the Strait of Hormuz, but certainly won't be. Customers won't be paying $110 per barrel. it will be a lot less than that. Maybe um, you know. Uh, when ships were being charged to move, they were being charged in the region of 2 million barrels per ship. um, we estimate that we could add $2 to $3 to a barrel of oil. So if we take that 80 as a baseline, and with geopolitical risk still present, and add $3, $83 is a lot less than 110. So that could provide some relief to consumers and allow the US, Israel, and Iran to maybe call an end to the conflict.
Nitesh, I was in an investor event last week in the UK, and a UK investor asked me this question, or made a comment rather. Why doesn't the UK just get all its oil from the US now that we have this situation? And I guess that question can be applied to a broader set of buyers. The idea being that why not look elsewhere for your oil supply, given this sort of a situation and the risk that it might happen again in the future, even if it's resolved this time around. Now, my initial instinct on that question or comment is, of course, we're talking about somewhere between a quarter and a third of global oil supply, which probably can't just be substituted by another source. But do you think there will be some rethinking of the supply chains and redirecting of supply chains, and countries reevaluating where their energy supplies and oil supplies in particular are coming from? Is it even possible, or will we make incremental changes? How do you foresee supply chains evolving given this situation has happened?
Yeah, I definitely think there will be some evolution in supply chains. But in the very immediate term, it's impossible to replace the Middle East region with just the US, because everybody's competing for the same cargoes, right? So you got to stack up the maths. If 20-25% of the oil is being shuttered in the Strait of Hormuz, and the US only produces about 13% of the world's oil, you can't replace one with the other, right? So even if um, uh, UK was able to get some preferential, um, treatment in accessing those cargoes, it won't be really enough. But everybody's looking for the alternative cargoes, and uh, that's the reality of things. Now, going forward, yes, I do think that over time, there will be more infrastructure build out. So more development of the oil and natural gas in the US, and more infrastructure to export it and send it to other places. Um, Probably still won't be enough. But just before the Iran conflict happened, we had regime change in Venezuela. Venezuela has the largest oil reserves, proven oil reserves, and over time that could get developed, and there could be new sources of supply. But everywhere you go, there is that risk of geopolitical risk to supply. Developing Venezuelan supply may be okay in this, where with this regime changes that we've just seen, but what happens out there afterwards? Um, and the developing of those oil supplies will take years. After the capex is put in, we're talking at least a decade before we really gain something meaningful out of the country. So there is that risk, and we've seen the risks in other parts of the world, right? Europe had a huge hydrocarbon dependency on Russia, and obviously we have a lot less now because of the Russia-Ukraine conflict. Um, Wherever you go, you've got some risks. Even relying on the US for supplies forever is a risky strategy, right? The US has clearly taken away its um, security umbrella for Europe and other parts of the world, and it could utilize its oil supplies in the same way to as a bargaining chip for its political goals. So I think reliance on any one country or over reliance on any one country is dangerous. Diversification is necessary, but it's not just diversification in terms of oil supply. I think it's a diversification on energy period, right? So moving away from hydrocarbon sources of energy possibly will be the best solution for this risk. Um, Especially when renewables are there. They are relatively cheap. If you look at levelized costs of production, uh, especially in an electrified world, um, wind and solar are definitely cheaper than all the alternatives. So, and when it comes to wind and solar, once the equipment's in the ground, um, you don't need to rely on ongoing supply, right? Yes, there is risk in getting the supply of the wind turbines and the solar panels, and believe me, there's a ton of you know supply concentration for all the components there at the moment. But once it's put in the ground and operational, the ongoing reliance on third party countries becomes reduced. So my guess is the policy dynamics will start pushing towards these types of solutions going forward.
Yeah, very good point, Nitish. Of course, that has been driving industrial metals lately. That narrative that countries will look elsewhere, turn towards renewable energy. And of course, all of those things are very metal intensive. But if you're driving an electric vehicle and the electricity supply in your home is fully renewable, then you are, of course, not affected by what's going on in oil markets. But before we go into industrial metals a bit further, Nitish, I wanted to get your thoughts on what's happening with the other super important commodity right now, which is gold. And gold's behavior lately, or sometimes, has had people uh, left scratching their heads a little bit. Sometimes, in the initial stages of a geopolitical crisis, people immediately expect gold to rally because it's always meant to be a defensive asset, a safe haven, a geopolitical hedge. But when a crisis happens, sometimes gold pulls back. This is something that I know you have to explain a lot to investors why this happens, and it happened recently as well. So I'd love for you to explain why this dynamic sometimes happens and what was the reason why it happened this time. But also, in the subsequent weeks, you mentioned the conflict has been going on for 3 months now. It feels like even in the aftershocks, after that initial escalation and the starting of the conflict, even later on, as we see things escalate, we see maybe gold often moving in the wrong direction, which is gold pulling back. Is that still happening, or has that stopped happening? Is it diminishing? How is gold behaving now as things escalate, things de-escalate, and why did it happen in the first place?
Yeah, so gold is a nice geopolitical hedge, and we've seen it time and time again. Deep geopolitical shocks or financial market shocks, and you look at gold prices, say 6, 12 months on from that, generally it's up. Now, obviously, in every episode, there's other things moving gold prices, but that's nice when you look at a very fixed time period after the shock event. But what happens in the in the time path is important. And when we look at most geopolitical shock events, normally gold prices fall before they rise, as you mentioned, and the mechanics behind what drives that is usually the same. Um, Gold is treated like a very liquid, cash like instrument. And when a geopolitical shock or a financial market shock event occurs, there is a thirst for liquidity. People need cash to meet emergency expenditures. For example, when equity markets fall quite drastically after the shock event, there's a lot of margin calls on futures positions. They need to be plugged. If you don't have cash available, you start looking for your next cash like equivalent, and that's usually gold, that gets sold down. Um, and it's not just investors who sell gold in stress points. Central banks do that as well. Central banks are often under pressure at those sort of points. In this conflict, for example, we saw Turkey central bank, for example, sell close to 60 tons of gold, or going to gold swaps essentially. So it had to release some of the gold to get dollar liquidity to be able to protect its lira, right? Because lira is under pressure. So that selling or releasing gold has a downward pressure on prices initially, but then it starts to recover. So most geopolitical risk events, we've seen this kind of pattern. This time, it was probably a little bit more prolonged and a little bit more. The drawdown was a little bit more pronounced, partly because gold was already falling before the Iran war started. If you remember back to January 2026, on the 29th of January, in fact, gold hit a fresh new high, $5,600 intraday. Um, and that was basically $1,000 added to gold price in the span of less than a month. It just looked um, unsustainable. And then it was proven to be unsustainable. Within the first few days of February, it had given up most of those gains. It's about $1,000 added to gold price. It took an entire year in 2025 to add $1,000 to gold price. And then before 2025, it took several years to add $1,000 to the price. That scale of upside was clearly unsustainable, fell, and but prices were falling throughout February. And so when the war started, gold was already on a negative momentum, and it probably had a little bit more further to go to release some of that was essentially froth at that point. Um, so the drawdown was a lot more pronounced, but by mid-April, we started to see gold prices settle, and we've generally been on an upward glide path since then. Yes, gold prices are wavering up and down. There's other things that influence gold prices, including bond yields and the dollar. But yesterday was a kind of so yesterday once again third that would have been 30th of April was a nice sort of test point because we did see yesterday um, at least perceptions of geopolitical risks rise again with the discussions of a short campaign, new campaign in Iran. Um, as I mentioned earlier, that led to oil prices initially rising first, but at the same time, gold prices rose. So that perception of higher geopolitical risks led to gold prices gaining. So it does feel right now that gold is a lot more back in line with common perception of when geopolitical risks rise, gold prices should rise as well. And I think that's going to be the supporting factor for gold. Now that the liquidity rush has kind of run its course, I do believe every risk of escalation will take the metal price higher.
It's interesting, Nitesh, you mentioned the froth in February because around that time, January, February, I had a couple of personal instances. Like I went into an Uber and I told the driver that I work in the world of investment, and the first thing he asks me, should I put my money in gold? And I said, do you have an investment account? And he said no. So here's this person who has never invested before. He doesn't even have an investment account, but he's considering putting his savings into gold. And then another instance where I was back home in Pakistan and some friends, they were talking about buying physical gold, and over there they don't even have the same access to exchange traded products, but they were talking about physically going and buying gold and storing it somewhere. Again, I asked them, do you invest? Do you invest in stock markets? Very different asset classes. They said no, but they are considering going straight into gold. So just the general awareness in the global, uh, in masses around the world, incredible at that time. That probably contributed to some of that froth. But you mentioned that since then it's now come back to its fundamentals, and it's now behaving more in line with how you expect it, which reminds me of your gold model, because you have a model which tells you exactly which fundamentals gold should be responding to. Have recent developments and the fact that gold is now at or around, depending on the day, but around that $5,000 mark, slightly below now, of course, uh, has that forced you to rethink any variables in your model, or are they still holding up?
Yeah, excellent. So, back in January, I was really struggling with the model, given where prices were heading, and it was clear that my model was predicting something significantly lower than the where we ended up. Um, Still, if you look at my model output and where prices are, prices still above, um, but the gap has narrowed significantly. Um, Now, what I do believe is that I think gold prices are um, reacting to this widened group of investors. I mean, as you were saying, people who never looked at gold before and barely looked at any investment before are actually interested in the metal. Um, it goes beyond that. Last year in 2025, Chinese insurance companies became eligible to buy gold, they're allowed to put roughly 1% of their assets in gold. Towards the end of the year, Indian pension funds were also eligible to buy gold ETFs or exchange traded products. And you've got things like Tether and other stable coins buying gold in very large volumes. So I view that the gold market is trying to ingest this much larger pool of investors, and even people who have been eligible to buy gold for a long time have been ignoring the metal, but are considering it, right? And even going from you know zero holdings to 0.5% or a percentage point, if you multiply that by millions of different investors, it starts to become something quite meaningful. So I think that gold prices are possibly heading higher, but to incorporate um, this stronger buying of gold by a wider group of people, um, and that is leading to a lot a new base for gold prices. So everything else that's in my model, and that model is really driven by macro factors like inflation, bond yields, dollar exchange rate, and some sentiment measures, including speculative positioning in futures markets. They're still all relevant, but they don't capture that structural increase in prices. And if the new group of buyers keep buying gold and keep buying at an elevated level, then that base is going to keep rising. So the way I see things is that the existing things in the model still matter, but it's hard to get the right level given these new buyers. Now, the events have led me to test the model a lot more. Try to look back and say, what if I change the style of modeling? What if I introduce more time series of other variables into the model? How would that, could I get ways of improving the model? So far, I haven't found anything that I'm satisfied with that does a better job. But I'm still working on doing that because it's a nice opportunity to reflect and see if I can improve some of the measures. One of the measures, for example, that measurement of um, sentiment towards gold. I use COMEX positioning in gold futures, for example, but that's just one portion of the market, right? What about Shanghai futures market? What about all the flows going into exchange traded products? What about the flows going into tokenized gold now? The sentiment could be measured in such a wider way. It's about sort of finding a way in which I can quantify that in a kind of a unified way and put that into the model. So there are things I'm working on, but none of them I'm quite satisfied with yet, and have improved the model outputs yet.
And can the same argument, we know your gold model is very well received by investors, so would love to see how the model evolves and those new variables come into the picture. You also have a model for silver, but very quickly, I'd extend the question beyond silver. I'd say silver, platinum, palladium, they've all sort of done what gold has done, that frothy rally in January, February before pulling back and now maybe behaving more in line with fundamentals and reality. Is that a fair assessment that th- that was a bit too much too quickly and now they're behaving more in line with how we expect them to do?
Yeah, definitely too much too quick. There was a short, sharp increase, in January. I mean, they've been all increasing throughout 2025 as well, right? But but that scale that came in January was just a bit off the, too exuberant, and they're pulling back now. Um, Silver, platinum, palladium, they're a lot more industrial than gold. And so when you get a very high prices for those metals, it's going to hurt the industrial demand for those metals. Gold, in contrast, is a lot more of a monetary type of asset, whereas there's a real world demand impact on the silver, platinum, palladium. Now, for silver, we'd seen a lot of thrifting already occur in the photovoltaics market, which was previously the strongest engine of growth for silver. And when we got to silver prices of $120 an ounce, that would have choked off a lot of demand. Now prices have pulled back, where uh, still, at just under $75 an ounce, maybe three times as high as we were at the beginning of 2025. So it's still expensive relative to its past, but probably a little bit more palatable. And as we discussed earlier on, there's probably going to be that drive for electrification with the energy crisis as well. So silver demand will probably remain good, but at high prices, it could choke off its own demand, and that is the clear worry. Supply is relatively constrained. It's in a supply deficit, although a narrowing one. So there's still good support for the metal. But yeah, I think we're at a much more reasonable price that could be maintained going forward. And I expect, well, with my model process, if I'm looking at a gold price of around 5,500 for Q1 2027. That's, I should stress, I treat that as the base. We'll probably have more upside relative to that if there's new buyers of gold keep buying. But in that scenario of 5,500 for Q1 2027 for gold, we could get a silver price of around 1992 by that same time point. So there's still upside and strong upside from here, but the key thing to worry about is, could industrial demand get choked off with very high prices that run up too quickly? And same with platinum, palladium, right? The main use for both platinum group metals is to go into the catalyst in internal combustion engine vehicles. Now, with the oil crisis going on, internal combustion engine vehicles are likely to suffer in terms of sales in favor of electric vehicles. So there may be a little bit hit on demand, but the ongoing thing is the supply is tight, right? The miners aren't investing much in their mines at the moment, so supply will likely remain tight and keep those metals relatively well supported. But I doubt we'll go back to the same highs that we saw in January.
So speaking of industrial demand and the drive for electrification, that brings us nicely to industrial metals. And recently, Nitesh, you've been participating in the various metal study groups. You've attended the meetings, you've presented. there as well. Would love to get your take. What's the narrative? What's the mood in these study groups? What are we talking about in terms of demand supply situation, the conflict? What can we expect from industrial metals?
Yeah, so each metal is slightly different and it has different fundamentals. But I guess one of the big common threads in all the discussions for nickel study group, copper study group, lead and zinc study group is the impact of the war and what it does to the inputs that are needed for metal production. And um, clearly, one of the things that's impacted right now is the availability of sulfur and sulfuric acid. It's very important for the leaching processes to take a convert an ore into refined material for some processes, and so the lack of availability there is damaging. So Iran is a massive exporter of sulfur. Um, and with the strait basically blockaded, um, it's not getting out to the markets. But on top of that, China has banned the export of its own sulfur as well. It wants to keep all its sulfur to itself. And sulfur is one of these weird things where um, metal processing actually some methods of processing, without going into too much detail, produce sulfur, which is useful for other processes which need the sulfur to for the leaching processes. So China being a massive a producer of all metals, has a variety of methods in making them, from the refining to the leaching to and every variant in between. And believe me, there were some presentations in the copper study group that described a lot of these processes that China has adopted. And and maybe I've got about 5 to 10% of the understanding of those things. I'm not a chemist or have a deep understanding of the science, but it is clear that they have got a wide array of production methods. So the guys producing sulfur as a byproduct are selling to those who are using it, and it works nicely for China. If they close the system and don't allow the export of that sulfur, which is very expensive and very much needed by smelters outside of out of China. So that's one key thing that came up. But every metal is different. If you look at the nickel market, um, it's a highly concentrated market, right? Indonesia is the biggest producer, roughly 60%, 60 to 70% of production. Its decisions are very meaningful. We talked about OPEC earlier on in the oil markets. Indonesia is even more important than OPEC in the nickel markets, right? OPEC maybe has 45% of oil production and 60% of nickel production makes Indonesia placed in the driver's seat. Unfortunately, Indonesia is not a nickel study group member, um, and it wasn't present. So it's a lot of guesswork on terms of what Indonesia is going to produce. But literally, around that time or days after, you know, Indonesia underscored the fact that it's going to be very restrictive in awarding um, the quotas to the miners and the smelters or the industry. So the so-called RCABs were held back at a relatively tight level. So that's keeping the nickel markets relatively tight. So the nickel study group have put out their forecast of a deficit for this year, but in contrast, the copper study group have flipped their forecast for 2026 balances to a surplus. So the damages to supply from Grasberg, etc. Yes, a negative for supply, but they're being overridden by new supplies from elsewhere and a pricing in of some demand side destruction as well. So um, you know, the metal study groups are very interesting to listen to, and they the delegates there are from a variety of backgrounds, from miners to smelters to um, government organizations. So it's very interesting hearing the opinions of this array, and combining their efforts to come up with a with the forecasts that come out of the study groups.
Yeah, it's interesting how there are some common threads and narratives that bind the story together, but each metal is unique nonetheless, and performance and returns, they aren't necessarily entirely uniform. Some commodities have done better than others. Like one that really stands out this year is lithium, a very strong performer year to date. And for our audience, we recently spoke to the CEO of Sigma Lithium, one of the biggest lithium producers in the world, from Brazil. And the CEO, Ana Cabral, one of the things she mentioned was the lithium industry was surprised over the last year or so by the strong demand from the AI industry. So just the fact that, of course, lithium is used in energy storage, and AI is now this huge new industry that requires energy storage, and and the whole industry was surprised by how quickly demand has picked up from this industry that just needs so much energy, and supply is now trying to play catch up, and that for a smaller market like lithium compared to, say, copper, has a bigger impact on prices, because even small dislocations in demand supply dynamics and balances can create large movements in prices. So we have written more blogs on this topic on our website, where we share forecasts from the International Energy Agency, longer term projections about where demand and supply dynamics are going. Very, very optimistic demand projections, less optimistic supply projections, which create this dynamic that, of course, if you don't invest in new mines, you're going to face supply shortages in the years to come. And maybe that's the narrative that lithium and many other industrial metals are beginning to price in as we see it now. Nitesh, as we come towards the closing stages of this conversation, we must, of course, spend some time on agricultural commodities. From our perspective at Wisdom Tree, we've seen a lot of investor interest in agricultural exchange traded products, particularly in the last few weeks. Not necessarily in the first few weeks of the conflict, and maybe that realization is starting to settle in that initially, yes, the impact was on oil and gas and the energy sector, but there are second order effects of the conflict, and those second order effects end up on the agricultural sector, because you need fertilizers to move through the strait, and if they can't, then of course the agricultural commodities will suffer. Energy prices going up have a knock on effect on agricultural commodities, but there are some other forces at play as well in the agricultural complex. So, Nitesh, how do you see what's going on in terms of how markets are behaving, how investors are seeing the opportunity, and what agricultural commodities have been doing lately?
Yeah, great observation. I mean, there's really elevated interest in the agricultural space at the moment, and for good reason, right? The agriculture is highly reliant on fertilizer, which is a petrochemical product essentially, right, made out of natural gas and petroleum products. um, that's trapped in the Strait of Hormuz, and farmers are worried that they don't have enough inventory of fertilizer, and they are thrifting its use. And its lack of availability means that crop cycles could get damaged, right? And it matters, timing matters, right? So even if the war ends next week, if there's a missed opportunity to put fertilizer in the ground, that crop is going to be damaged. Its yield is going to be permanently damaged for this crop cycle. So there's no catch up to be made at some point. Um, you know, the fertilizer needs to be in the ground for the crop to prosper. So most agricultural commodities are getting some lift from this lack of availability of fertilizer, but also uh, crops are not just there for human consumption. They also act as a type of energy source. You've got biodiesel, you've got ethanol, all being used as a form of energy. So that lack of fertilizer will impact the availability of these biofuels. The oil price increase in of itself is creating more demand for these alternative energy sources. Once again, putting pressure on agricultural prices to the upside. Um, then if you think about the specific markets like Brazil, uh, where the consumer can go to the petrol station or the gas station and look at the prices of both ethanol and petroleum or gasoline. Um, it's truly visible. It's completely transparent because they have these things called flex cars, basically, that can take either fuel, and they can just compare the price at the pump and say, okay, I'll decide to put this in. Now that most of Brazil's ethanol is made out of sugar cane, and so when more cane gets diverted into ethanol production, that leaves less sugar available for human consumption, and we've seen sugar prices take a lift as a result. So it's highly supportive for the sugar markets. Um, but the risks go beyond what's in the related to the war. The big meteorological organizations have increased their risk of a El Nino weather pattern this year. Um, El Nino is this phenomenon when point. I'm not sure if you can see my map here, but the body of water between sort of in the Pacific heats above a certain level, it changes trade wind patterns, and that has an impact on weather. Um, in key growing regions. Now, typically, we find that the tropical crops, the softs in particular, so cocoa, sugar, coffee, they tend to be more impacted by El Nino weather patterns, and the meteorologists are saying that this could be a strong El Nino, not just a relatively weak one, right? Like we've had in the last few episodes of El Ninos in the last couple of decades, and so if that happens, we could see a significant disruption to um, many agricultural crops, softs in particular, and that could drive the prices of those higher. Now, as you sort of put in your sort of framing, what we thought was initially an energy shock has clearly rippled out into something much bigger, right? We've gone from energy prices to metal prices, now to agricultural prices. It's happening sort of sequentially, and it does really indicate that being broadly exposed to commodities is the best approach to hedge against all the inflationary risks that are coming from this conflict. Um, and Moreover, we've looked at historically, and late economic cycles are generally the best time to be in commodities. And arguably that's where we are right now. So sometimes, even though these shock events that nobody predicted are driving in the driver's seat for prices, here and now, um, we knew that broadly speaking, late economic cycles are generally good for commodities. And so, um, even if conflicts are resolved, we do think that commodity prices will still remain possibly the best place to be in terms of asset allocation.
You are very well placed, Nitesh, to talk about the El Nino effect with the map behind you. So we'll certainly return to that if that remains something that continues to affect agricultural commodities in the months to come. But you will, of course, for our audience, hear more about those idiosyncratic stories. Our colleague Anika Gupta, she recently wrote something on cotton as well, about how cotton has been performing particularly well because there's supply tightening happening and the market is moving from a surplus to a deficit. Production has been low in China, particularly, and global inventories are falling. And then, of course, there is the energy shock as well, which has some second order impacts because it raises polyester costs, and sometimes people substitute and turn to cotton as an alternative. So demand going up and supply going down, and of course that is just the dynamic that moves commodity markets up. So you will keep hearing more from us on those commodities and much more on this podcast and on our blogs. So tune in, check it out. But for now, we will bring this discussion to a close. But before we go, I do need to state the following to clarify: the views and opinions expressed in this podcast are those of Wisdom Tree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. If you want to hear more from us, please do follow us on LinkedIn, X, check out our website, wisdomtree.eu. And of course, you can follow Nitesh or me on any of those platforms as well. Tune in next time to hear more about commodities. We'll see you then.